Welcome everyone, you have come to Thrive to Invest. My name is Neeraj. This is the right place if you want to know more about investing. Today's video is around the two broad categories of investors that exist. But before we get into those two broad categories, let me talk a little bit about importance of investments in our life, and that's the motto of this channel. Investments are really important. All of us should be in a habit of investing money regularly. We should work on a formula wherein we dedicate a certain percentage of our total income and put it away as our investments. A couple of things: decide that percentage very carefully and know the difference between savings and investments. To know more, you can refer to my earlier videos. There is no right or wrong age of starting investments. The earlier you start, the better for you. If you continue to invest regularly, you secure your future, and by the time you retire, you gain financial independence. Another important benefit of investing regularly is that you get a good average price of your investments. Rather than putting a lump sum in the market that may well turn out to be a wrong time, you spread out your investments throughout your life, invest every month, and gain from the good average price of your investment by following this process. Before we start investing, it is very important for all of us to introspect a bit and figure out what kind of investor are we, and what are the key fundamentals that we need to focus on based on the categorization that we fall into. In today's video, we'll try and categorize all the investors under two broad categories. These broad categories came up more than 70 years ago when Benjamin Graham wrote The Intelligent Investor. It is by far the best book written on the art of investing. If you get an opportunity, please go ahead and buy and read that book. The categorization mentioned in The Intelligent Investor are still relevant, and most of the researches and theories still refer to that book to come up with any sort of conclusions. As an investor, you can fall into two categories. The first one being you can be an enterprising investor or an active investor. The second category is you can be a defensive investor, or also called a passive investor. Now let's talk about the characteristics of each of this style in a little more detail. Active investors devote more time to investing. They are more regularly in checking their investment and finding opportunities to invest in the market. Active form of investment also involves relatively deeper level of research into the companies or the businesses that you are investing in. Active investing involves regular trade transaction based on your analysis of the market. Needless to say, you should have certain level of experience, expertise, and knowledge if you are an active investor. Based on these characteristics, many of the private investors and professionals are not suitable to be an active investor. Firstly, private investors, salaried people, and professionals do not have enough time to be an active investor and monitor the market very regularly and closely. Secondly, it's very easy to fall victim of the fluctuating prices and emotionally driven decisions in the stock market that may end up in making losses for you. Now let us talk about the second type of investors, which are called passive investors. They are called passive investors because they invest passively, or in other words, they are willing to dedicate limited time to investing. They also do not carry out extensive researches on the companies or the businesses or the shares that they invest in. Passive investors do not invest in fund managers who can track your portfolio and give you regular updates. Passive investors follow a buy and hold strategy. They don't make regular trade transactions in the market, and they have a long-term vision. Most of the people who are into investing fall into this category of being a passive investor. If you are salaried and you are in a regular 9 to 5 job, if you are a professional like a doctor or a lawyer, if you run your own business like real estate, like retail, you are most likely a passive investor if you are into this habit. This is because you don't have enough time to devote to investing due to your professional obligations or the commitments at home front. So one question that you must be wondering about is, which type of investing makes you more money? Is it true that if you devote more time, you end up making more returns, and if you devote less time, your returns are lower? Well, actually not. In fact, most of the times the opposite comes out to be true. In the long run, in most of the cases, we have seen that passive investing turns out to be more profitable than active investing. This is because even the most experienced active investors try to predict the market fluctuations and time the market, but my friend, no one has ever done it worldwide. So at times their investment decisions turned out to be emotionally driven and leads to losses. versus passive investing, which is very systematic and periodical. You continue to invest money at regular intervals based on your appetite. This results in you enjoying a good average price because you go through all the growth and the drop phases. However, one point that I would like to say is that stock markets and the return that you get from stocks is highly mathematically derived conclusions. Those conclusions may lead you to contradict this point that I just made, but in most cases, it is seen and evident that people who continue to invest passively at regular intervals end up making more profits than the active investors. At the end, my friends, I would like to say that investing requires a lot of patience, discipline, learning, investment of time, and improving your skills as an investor so that you can develop your expertise and increase and maximize your returns in this market. So now I'll let you decide which category of investors you fall into. I'll be coming up with more videos and I'll be sharing the fundamental principles that people should keep in mind based on their investment style so that you can maximize your returns. Thank you for watching this video. If you have not subscribed to my channel yet, please do that to support me. Like this video, share it with your friends who need this kind of advice, and I'll see you very soon. Thank you.